Have you ever wondered what happens when a booming economy collapses overnight? The Panic of 1819 was the first major shock the United States faced after years of territorial expansion and widespread optimism. Many believed that prosperity was endless, but the result was a devastating crisis that exposed the weaknesses of an uncontrolled economic system. In this video, you'll uncover the secrets behind this historic moment and how it forever changed the way Americans view money, banks, and the government. Curious about how one crisis shaped a nation? Stay tuned. The economic and social context before the Panic of 1819 ***. Before the Panic of 1819, the United States was in a moment of optimism. The expansive nature of the country, with vast agricultural lands and commercial opportunities, generated a sense of limitless growth. After the War of 1812, the country was rebuilding economically in a way that seemed innovative and prosperous. However, this prosperity was deceptive, hiding fragilities that were about to be exposed. Land speculation and easy access to credit fueled consumption and investment in an extraordinary way, but many failed to see how unstable the foundation was. State governments and local banks expanded credit without restrictions, creating an atmosphere of euphoria. The public's curiosity about the westward expansion, combined with disorganized monetary policies, was a key ingredient for the disaster to come. This period of economic euphoria, however, hid the dangers of an impending collapse. Problems began to accumulate due to the lack of financial regulation, and the sense that everything was possible was about to clash with reality. The excessive speculation in Western lands and the massive printing of money inflated the economy, but also created an unsustainable bubble. The financial system at the time was heavily reliant on credit, and with relatively new and inexperienced banks, oversight was inadequate. This led to overconfidence and dangerous expansion. An interesting phenomenon is how people, driven by curiosity and ambition, invested without measuring the consequences. Little did they know that the age of unchecked optimism was about to transform into the first major depression in American history. The period was also marked by innovations in banking and finance, such as the establishment of the Second Bank of the United States, which promised to support growth. However, these promises ended up contributing to the crisis, as banks began issuing paper money without sufficient backing in gold or silver, further destabilizing the system. What seemed like a policy to encourage growth actually created a dangerous environment. The lack of a stronger regulatory system allowed this expansion to occur without necessary precautions. The belief was that the United States was entering an era of infinite prosperity, but as mentioned, this was based on fragile foundations. The arrival of the Panic of 1819 proved that this perceived solidity was only an illusion. In this context, it's fascinating how speculation on Western lands played a central role. These lands, seen as an incredible and virtually infinite natural resource, became the focal point for investments by both large entrepreneurs and small farmers. The promise of easy profit led many to go heavily into debt to acquire these lands, betting that their value would continue to rise indefinitely. But economic reality is far more complex than optimism suggests, and the land bubble was about to burst. The uncontrolled development of new settlement areas helped inflate a sense of prosperity, while also masking the underlying dangers of the speculative fever. Indeed, the Panic of 1819 exposed the limits of this unbridled growth. As credit became increasingly difficult to obtain, local banks began to fail, and confidence in the economic system was shaken. Thousands lost their savings, and the expansion of the West, which had seemed like an extraordinary destiny for many, turned into a nightmare. Farmers and merchants who once saw land purchases as a sure path to wealth were now drowning in debt. The system, which had seemed to function like an intelligent engine of progress, began to show deep cracks. Thus, the collapse was inevitable. Banks that had granted credit recklessly began tightening their policies, demanding loan repayments and refusing new loans. This created a domino effect in the economy, with businesses and individuals unable to pay off their debts. What had been a euphoric scene quickly turned into panic. The economic depression that followed was a historical lesson for the United States, a reminder that growth must be sustainable or its effects can be devastating. Monetary policy and the Bank of the United States ***. Monetary policy played a crucial role in the unfolding of the Panic of 1819. The Bank of the United States, created to stabilize the economy and regulate credit, became a central figure in this extraordinary event. However, its policies ended up contributing to the crisis. After the War of 1812, the bank quickly expanded credit, stimulating the economy and encouraging investments, particularly in the agricultural sector and western lands. With abundant credit, both small farmers and large businessmen believed that prosperity was guaranteed, which further fueled speculation. It seemed like an innovative solution to the country's growth, but the foundation of this expansion was fragile and dangerous. The central problem with this policy was the unchecked issuance of paper money by state and private banks. The Bank of the United States, which was supposed to ensure system stability, failed to adequately control this practice. Easy credit and the lack of restrictions created a bubble of confidence, leading many to believe that the value of land and agricultural products would continue to rise indefinitely. A fascinating phenomenon to observe is how this exaggerated confidence distorted people's perception of economic reality. When the bank decided to tighten credit to control inflation and restore monetary stability, the effect was devastating, as it revealed how dependent the economy had become on easy credit. This sudden monetary tightening shocked the system. Many local banks, which relied on the Bank of the United States to maintain their reserves, were forced to close, resulting in a wave of bankruptcies. Merchants, farmers, and investors found themselves unable to pay off their debts, leading to a wave of defaults. What had seemed like a necessary control of inflation ended up plunging the country into a deep crisis. The curious thing here is that the very mechanism created to ensure financial stability, the Bank of the United States, ended up directly contributing to the collapse by not fully measuring the consequences of its actions. Another interesting point was the impact on the agricultural sector. Many farmers, encouraged by easy credit, had gone deeply into debt to buy more land, believing that the value of these properties would increase over time. However, when credit dried up, they were left with debts they couldn't pay and lands that suddenly lost much of their value. The result was a series of foreclosures that ruined the lives of thousands of families. This phenomenon, which began with hopes of wealth, quickly turned into an economic nightmare. The crisis revealed how vulnerable and immature the American monetary system still was. In this context, the restrictive policies of the Bank of the United States also generated great distrust of the institution. Many Americans began to see the bank as an oppressive force that, instead of promoting growth, had caused a downfall. This led to intense debates about the role of government and banks in the economy, a discussion that would continue to influence economic policies for decades to come. The public's curiosity about how financial decisions were made led to a growing movement against banking centralization. The idea that economic power was concentrated in the hands of a few generated resentment, especially among farmers and small business owners who felt the weight of the crisis. The loss of trust in the banking system also had long-term effects. The Bank of the United States' inability to manage the crisis showed that the country needed a more robust approach to financial regulation. The bitter experience of the Panic of 1819 served as a historical lesson, demonstrating the importance of a balanced monetary policy. Although the bank was created with the intention of promoting stability, its lack of proper control and its delayed response to the crisis only made things worse. For many, the panic was a lesson in how credit, when mismanaged, can be a double-edged sword. Finally, the collapse of credit and the bankruptcy of thousands of banks generated a cycle of economic contraction that lasted for years. Public trust in banks was never the same again, and future monetary policies would be treated with much more caution. The lesson was clear. Credit can be a powerful growth tool, but if not regulated properly, it can lead to chaos. The Bank of the United States, which had the power to prevent the crisis, ended up being remembered as one of the main catalysts of the Panic of 1819. The impact of the crisis on small farmers and American families ***. The Panic of 1819 was particularly devastating for small farmers and their families, who were at the heart of the country's economic growth at the time. The westward expansion of the United States had attracted many of these farmers, driven by curiosity and hope to build a better life through acquiring fertile land. However, this gamble turned disastrous when the speculative bubble burst. Many had gone deeply into debt to buy land, confident that future earnings would allow them to repay their loans. But with the collapse of credit, foreclosures became a common phenomenon, forcing thousands of families to abandon their properties. The dream of prosperity turned into a nightmare. The credit system, which had seemed so innovative and promising, revealed its brutal weaknesses. With banks failing and money becoming scarce, many farmers could not sell their crops or secure the financing needed to keep planting. The lack of money flow and the economic contraction directly affected these families, who relied on the sale of their agricultural products for survival. Moreover, the drop in product prices, particularly agricultural ones, deeply impacted rural family incomes. The extraordinary agricultural success that sustained thousands of livelihoods quickly evaporated, leaving many without resources to start over. Rural families also suffered socially and emotionally. Losing land was much more than an economic impact. For many, it meant losing their livelihood, their home, and their identity as landowners. Poverty spread, and the number of people forced to abandon their land to seek work in urban areas increased drastically. This rural exodus created a sense of despair and helplessness among those who once believed in the security of land ownership. The psychological impact of this loss was profound, and the crisis left lasting scars on how Americans viewed the economic system. Interestingly, the crisis did not just affect rural areas. In cities, many families also suffered from bank failures and the lack of credit. Small business owners who relied on loans to keep their operations running found themselves on the verge of bankruptcy. The closure of shops and factories led to a significant rise in unemployment. The phenomenon of economic contraction affected all classes, but it was the small farmers and working families who felt the effects most deeply. Communities, which until then had seemed resilient and innovative, were hit hard by this first major American depression. The crisis also exposed the lack of social and economic safety nets for these families. Without a social security system, those affected by the Panic of 1819 were left to rely on their own luck or local charity. Churches and local communities tried to help, but there was no formal mechanism to cope with a crisis of this magnitude. This social vulnerability became one of the biggest challenges for the government, which began to realize the need for more structured policies to protect citizens during times of crisis. The panic revealed, in an extraordinary way, the flaws in the support system for working families. Beyond the economic and social impact, the Panic of 1819 also had a profound effect on people's political attitudes. Many small farmers and workers began to question the economic and monetary policies that had allowed this catastrophe to happen. The perception that the government and banks were more interested in protecting the wealthy while the poor suffered created a sense of discontent. This resentment helped shape future agrarian and monetary policies in the United States, influencing political movements that advocated for greater protection for small farmers and merchants. The effect of the Panic of 1819 on the banking sector ***. The banking sector was directly hit by the Panic of 1819, and its consequences were felt for a long time. Before the crisis, banks had expanded extraordinarily, taking advantage of economic growth and high demand for credit. However, the nature of this banking system was extremely vulnerable. Many state banks operated without sufficient reserves of gold or silver to back the paper money they issued, creating an inevitable financial bubble. When the Bank of the United States adopted a policy of monetary tightening, many of these banks couldn't survive in the new reality. Bank failures became a common phenomenon, generating widespread panic as people rushed to withdraw their deposits, only to find that the money simply wasn't there. The failure of state banks, which had already been operating with fragile regulation, was one of the most striking characteristics of the collapse. These banks, which once seemed innovative by offering accessible credit, showed an enormous inability to cope with a credit crisis. The reserves, which were supposed to be a guarantee of stability, were quickly depleted as customers tried to recover their deposits. A fascinating phenomenon was the public's curiosity about what was happening. For many, it was the first time they realized just how interconnected and fragile the financial system truly was. The banking sector, which had promised to be the backbone of economic development, revealed itself as a source of vulnerability. The crisis in the banking sector not only closed financial institutions, but also destroyed public confidence in the system. People, who had once trusted banks to safeguard their savings and finance their investments, were now suspicious and hesitant to place their money in these institutions again. This collapse of confidence created an even greater credit crunch, worsening the economic contraction. Small merchants, farmers, and even large businessmen, who depended on bank loans, saw their operations come to a halt. The credit contraction was so deep that it took years for both the banking sector and the broader American economy to fully recover. The extraordinary impact of this lack of trust was reflected in how the country would view financial regulation in the future. Curiously, the banking collapse led to a movement to revise government financial policies and the country's relationship with banking institutions. Many of the post-crisis criticisms of the banking system focused on the need for stricter oversight. The Bank of the United States, which was blamed by many for worsening the crisis by tightening credit, also became a target of intense debates. The flaws exposed by the crisis demonstrated the need for greater control over credit creation, an understanding that, while obvious today, was a novelty at the time. The idea that the banking system could collapse so easily created widespread curiosity about the real regulatory capacities of the government. Additionally, the crisis highlighted the extraordinary problem of speculation and the credit bubble that banks helped inflate. Without adequate regulation, many banks had issued more paper money than they could guarantee, especially to finance land purchases in the West. This phenomenon proved disastrous when land prices plummeted, and banks began demanding repayment of loans that could no longer be settled. The lack of banking regulation generated such widespread distrust that, after the Panic of 1819, Americans began demanding greater transparency and responsibility from banks, something that would shape future economic policies. The impact on the banking sector also influenced future reforms. Many regulators realized that the banking system needed to be more centralized and tightly controlled. The wave of bank failures revealed that the country still had much to learn about financial management. The crisis taught the lesson that economic growth must be supported by an intelligent and stable financial system. It was from this catastrophe that the first ideas of stronger banking regulation emerged, eventually leading to major reforms in the following decades. Thus, the collapse not only destabilized the economy in the short term, but also left an important legacy for the financial history of the United States. The government's response to the Panic of 1819 The government's response to the Panic of 1819 was one of the most revealing and historic moments for the young American nation. Initially, the federal government appeared hesitant and ill-prepared to deal with a crisis of such magnitude. The decentralized nature of economic policy at the time, coupled with the lack of experience in handling recessions, made the initial reactions ineffective. Congress, which had no clear precedents for how to act during financial crises, did not immediately implement policies that could have alleviated the devastating effects of the Depression. This initial inaction only worsened the situation for the most vulnerable groups, such as small farmers and merchants. One of the first attempts by the government was to ask the Bank of the United States to intervene and provide relief to the banking system. But this action proved insufficient. The bank, in turn, was more focused on ensuring its own stability and recovering its profits than on offering a broad solution to the crisis. The government, realizing it relied too heavily on the central bank, began to discuss the need to reform its financial policies and its relationship with banking institutions. Economists at the time were curious about whether the government should be more interventionist or remain distant from the financial sector. This uncertainty fueled political debates in the years that followed. Despite being late, some measures were taken to alleviate the crisis's impact, although in a limited way. An interesting example was the federal government facilitating the renegotiation of debts for farmers and merchants, particularly those who had acquired land in the West. This renegotiation of public lands helped reduce the number of foreclosures and brought some temporary relief to those who were drowning in debt. However, this policy was seen as a partial solution, as it did not directly address the causes of the crisis, such as a lack of banking regulation and unchecked credit speculation. The general feeling was that the government was reacting, but without a clear vision of how to prevent future crises. Another curious aspect of the government's response was the lack of direct intervention in the banking sector, leaving many states to rely on their own capacities to cope with the collapse. Several states attempted to create bankruptcy laws or regulate their local banks more strictly, but these initiatives were largely ineffective due to the depth of the crisis. The extraordinary level of fragmentation in economic policies between states made it difficult to implement broad, coordinated solutions. This sparked intense debate about the role the federal government should play in economic regulation, a discussion that would resonate for decades and influence future interventions during times of crisis. The president at the time, James Monroe, faced criticism for his handling of the panic. Although his administration had good intentions, the lack of decisive action by the federal government led many citizens to question the effectiveness of the economic policies in place. Debates in Congress became heated, with some voices calling for more protectionist policies and others insisting on maintaining a more liberal and autonomous economy. This division reflected the public's curiosity about which direction the United States should take in terms of government intervention in the economy. The crisis revealed the need for a more prepared government to intervene in times of economic depression, something that had not previously been considered a priority. The government's response to the panic of 1819 also created a legacy of distrust toward financial institutions and the political elite. Many small farmers and merchants, who felt abandoned during the crisis, began to see the government as complicit in the interests of large financial powers. This resentment sparked populist movements, demanding greater control over banks and more direct protection for working classes. The crisis, therefore, not only destabilized the economy, but also changed the political landscape of America, planting the seeds for future reform movements and greater government oversight. Finally, the impact of the government's response, or lack thereof, left a deep mark on how the United States would handle future crises. The Panic of 1819 showed that the government needed to be more attentive and prepared to intervene in times of economic depression. Although the crisis was a hard lesson, it spurred future changes in economic policy and the way the federal government would deal with the banking system and financial regulation. The economic and political lessons from the Panic of 1819. The Panic of 1819 left an impressive legacy of economic and political lessons for the United States. One of the key takeaways was the fragility of an economic system without robust financial regulation. The crisis demonstrated in a painful way that growth based on uncontrolled credit and speculation could be destructive. Banks, which were supposed to be the solid foundation of economic development, proved vulnerable as they were not prepared to handle the credit demand during a crisis. Thus, it became clear that a financial system, no matter how innovative it seemed, needed balance between credit supply and real guarantees to avoid collapse. Another crucial lesson was the importance of smarter monetary policy. The Bank of the United States, which was meant to ensure stability, ended up exacerbating the crisis by tightening credit too suddenly. This opened a debate about the role of central institutions in managing the economy and controlling the money supply. Economists at the time became increasingly curious about questions such as, how far should the government and the central bank intervene in crises? Although the United States was in a period of growth, the collapse showed that restrictive and poorly planned policies could lead to a deep and prolonged depression. Politically, the Panic of 1819 highlighted the need for reforms in the banking system. Many of those who suffered from the crisis began to question the role of the government and the financial elites, which generated a movement for stricter supervision. This period marked the beginning of a more critical political awareness regarding the concentration of economic power in the hands of a few. The public began demanding greater protection against speculation and the abuse of power by banks. The extraordinary growth of popular resentment led to future debates about the need for a more regulated and fair economy, which would culminate in important reforms in the following decades. This dissatisfaction also had a direct impact on elections and politics in the subsequent years. Many politicians began to align themselves with popular demands for banking reforms and greater protection for small farmers and entrepreneurs. A clear example of this phenomenon was the growing support for movements advocating for greater decentralization of financial power and an economy less dependent on institutions like the Bank of the United States. The panic sparked political awareness among the working classes, who began to demand a more active voice in economic decisions, seeking to create a system that was more accessible and fair for everyone. Another important point is that the Panic of 1819 also exposed the lack of social protection mechanisms. The crisis showed that the United States was still far from having a safety net for the most vulnerable. Families who lost their land or businesses were left to fend for themselves. This historical lesson sparked reflections on the need to create support systems in times of crisis, something that would only begin to be seriously discussed by the end of the 19th century. The crisis revealed that, in addition to smarter economic policies, the country needed to think about ways to ensure that the social impact of recessions was minimized. Finally, the Panic of 1819 also taught the United States the importance of a more diversified economy. The excessive reliance on the agricultural sector and easy credit for territorial expansion ended up being one of the main causes of the collapse. Many farmers and entrepreneurs who relied on land speculation saw their fortunes disappear when credit was cut and prices plummeted. This dependence showed the need to create a more shock-resistant economic system by investing in different sectors and diversifying income sources. It was a wake-up call that sustainable growth must be balanced so that a crisis in one sector doesn't bring down the entire economy. Thus, the lessons from the Panic of 1819 were not only economic, but also political and social. It marked a turning point in how the United States viewed the role of the government, banks, and credit in building a stable economy. The country learned in a painful way that growth, to be truly sustainable, needed to be based on balanced policies, fiscal responsibility, and protection against speculative crises. The social impact of the Panic of 1819 The social impact of the Panic of 1819 was as deep as its economic consequences, directly affecting the daily lives of thousands of Americans. As the financial crisis worsened, many families saw their savings evaporate, leading to a significant rise in poverty. Foreclosures became a common reality, particularly for small farmers who had bet everything on lands that were now devalued. This loss of property was devastating because land ownership was not just a source of income, but also a form of stability and identity for these families. In short, the extraordinary financial collapse completely changed the reality for those who once dreamed of prosperity. The crisis didn't just affect farmers. In urban areas, the closure of banks and the bankruptcy of small businesses triggered a wave of unemployment that spread rapidly. Workers who relied on wages to support their families suddenly found themselves without options, and many were forced to seek work in increasingly precarious conditions. The lack of credit and the scarcity of money affected local commerce, and even those who had well-established businesses were hit by the economic contraction. This phenomenon led to a deterioration in living conditions, with many families having to live extremely modestly to survive the recession period. Cities also face a rise in crime and violence as the unemployed and desperate population sought ways to sustain themselves. Without a welfare system to support the neediest, American society was severely impacted. The Panic of 1819 revealed the limitations of the economic model in providing a safety net for its citizens. Churches and charitable organizations tried to help, but there was no way to meet the growing demand for assistance. This social abandonment generated a cycle of misery that dragged on for years, making it clear that extraordinary prosperity, no matter how great it seemed, could be fleeting. A fascinating aspect of the crisis was how it changed the perception of the working and rural classes toward the government and financial institutions. Many began to blame the political and economic elites for the collapse, believing that the government had allowed banks to exploit small property owners and merchants. This sense of injustice generated a movement of political awareness among the less fortunate classes, who began to organize around ideas of land reform and stricter control over the banking system. Public curiosity about how the economic system operated grew, and the most affected classes began to question the fundamentals of an economy that seemed to benefit only a small portion of the population. Moreover, the social impact of the crisis was not limited to the U.S. territory. The Panic of 1819 had international repercussions, as global trade also suffered from the economic downturn in the United States. Many European countries, which had become dependent on American imports, particularly in the agricultural sector, felt the effects of the crisis. This created a domino effect that intensified the suffering of working classes and created a sense of global crisis. The extraordinary collapse of international trade was another layer of the social impacts that unfolded from the American crisis. Economic contraction also impacted social mobility. Many people who had previously been able to rise economically by purchasing land or investing in businesses saw their opportunities disappear. The American dream of upward mobility seemed distant for most of the population. For many, the crisis was a harsh reminder that financial success was uncertain and that the promise of prosperity could easily be interrupted by external factors. The Panic of 1819 made it clear that, no matter how intelligent and innovative a system might appear, it had flaws that needed to be addressed to ensure true social stability. Finally, the social impact of the crisis shaped how Americans viewed the economy and the role of government. The sense of vulnerability was so strong that working classes began to demand greater protection and economic fairness. The seeds for future reforms, which would come in the following decades, were planted during this period. The extraordinary social shock caused by the Panic of 1819 was a reminder that growth and prosperity must be accompanied by mechanisms to protect those who suffer the most during crises. The changes in perception of the banking and financial system. After the Panic of 1819, the perception of the U.S. banking and financial system underwent a deep transformation. Before the crisis, there was widespread belief that economic growth, driven by easy credit and territorial expansion, was inevitable and endless. However, the financial collapse shattered that confidence. Bank failures and unchecked speculation revealed how unstable and risky the system could be. This generated collective curiosity about how banks actually operated and how political decisions directly influenced the lives of ordinary people. Many, for the first time, began questioning the safety of entrusting their savings to these institutions. An interesting phenomenon was the rise of distrust toward the Bank of the United States and large banks in general. Once seen as pillars of economic growth, banks became part of the problem, responsible for fueling speculation and cutting off credit at critical moments. The Bank of the United States, in particular, was accused of worsening the crisis by tightening credit just when people needed access to money the most. This negative perception influenced public debate, with many arguing that the central bank and state banks needed stricter supervision and that economic power shouldn't be so concentrated. The crisis also sparked a shift in expectations regarding the government's role in regulating the financial system. The absence of effective control over the issuance of paper money and banking practices became evident during the Panic of 1819. This event served as a wake-up call for the need to create a more robust and secure financial system to protect the economy from collapses like this. Over the following years, debates over financial regulation intensified, and the ideas of greater government oversight began to gain traction. The extraordinary impact of the crisis on the banking sector made this discussion inevitable. Another fascinating point is how the public became more aware of the dangers of unchecked speculation. Many Americans, driven by curiosity and the ambition for quick riches, had gotten involved in speculative schemes, especially in the Western land market. The crisis made it clear that these practices were highly risky and that sustained growth needed to be based on solid economic fundamentals. What once seemed like an intelligent investment strategy was now seen as a trap that could lead to disaster. The experience of the Panic of 1819 taught valuable lessons about the importance of prudence and responsible financial management. Changes in perception of the banking system also had a significant impact on future generations of entrepreneurs and investors. The crisis created a desire for greater transparency and accountability in financial practices. Many began to demand that banks be more cautious in lending and that speculative practices be curbed. This new mindset shaped how the country would approach economic development in the coming years, leading to a demand for regulations that would ensure stability and prevent similar crises. The extraordinary lesson learned was that easy credit and unchecked expansion could bring growth, but could also cause economic devastation. One of the most notable legacies of the Panic of 1819 was the creation of a mindset of caution and vigilance regarding the financial system. The public, which had once blindly trusted banking institutions, was now more aware of the risks and pitfalls of credit and speculation. This generated a movement of greater popular participation in debates about economic policies and pressure for the government to take more concrete measures to protect citizens from future crises. The crisis exposed the system's flaws, but also created an opportunity for reforms that would shape the country's economic future. Finally, the transformation in how the banking and financial system was perceived after the Panic of 1819 was a crucial step in the evolution of the U.S. economy. The lessons learned about the need for regulation, responsibility, and transparency helped build a more resilient financial system, better prepared to deal with future challenges. The extraordinary impact of the crisis on the banking sector served as a turning point, leading the country to rethink how money and credit should be managed to ensure lasting prosperity. Economic recovery after the Panic of 1819. Economic recovery after the Panic of 1819 was slow and fraught with challenges. The deep impact of the crisis left lasting scars across various sectors of the economy, but it also brought important lessons about resilience and adaptation. One of the first steps taken to ease the recovery was renegotiating the debts of small farmers and merchants, particularly those who had lost their land or businesses during the collapse. Although the recovery was gradual, this measure provided some relief for those most affected. However, what stood out during this period was the American people's ability to reinvent themselves and seek new growth opportunities. Recovery was driven mainly by the agricultural sector, which slowly began to rebuild. The prices of agricultural products, which had plummeted during the crisis, began to stabilize as supply and demand found a new balance. The extraordinary adaptability of farmers, many of whom adopted new farming techniques or diversified their crops, was essential to this recovery. Small adjustments in land use and personal financial management helped to slowly rebuild the rural economy. The resilience shown by the workforce in the countryside was one of the pillars of recovery. In cities, the manufacturing sector also began to recover, although more slowly. The initial collapse of banks and the lack of credit made it difficult for industries to restart, but over time, market confidence was gradually restored. Innovation was key in this process. Many entrepreneurs, faced with the difficulty of obtaining credit, found creative ways to finance their operations, such as forming cooperatives or using their own resources. The American economy, with its extraordinary nature of constant evolution, once again demonstrated its ability to adapt and innovate in the face of adversity. Gradually, commerce began to flow again, and employment in urban areas started to recover. Recovery was also marked by greater caution in the use of credit. Both banks and individuals became more conservative in their financial practices, avoiding the kind of reckless speculation that had led to the crisis. This shift in mentality, surprisingly, helped to create a more solid foundation for future growth. Banks, learning from past mistakes, began to operate more responsibly, and the government initiated discussions about establishing stricter regulations to prevent future collapses. It was a moment of transition where the American economy moved from a phase of rapid, uncontrolled growth to a more conscious and balanced model. Another interesting point was the government's role in the recovery. Although the initial interventions had been limited, the impact of the Panic of 1819 encouraged the government to start thinking about long-term strategies to protect the economy from future crises. Debates over financial regulation and monetary policy began to gain traction, and the idea that the government should play a more active role in supervising the banking system became increasingly popular. Although the actual reforms would take more time to implement, the Panic of 1819 planted the seeds for a more regulated and prepared financial system. Additionally, economic recovery was also driven by continued westward expansion. Despite the crisis, many Americans continued to venture into new lands in search of opportunities. The West still offered vast areas for cultivation and settlement, and with the stabilization of land prices and the gradual return of credit, many were able to restart their lives. The curiosity and pioneering spirit characteristic of the American people kept westward expansion alive, and this, in turn, helped to revitalize the economy. The West would become, in the following decades, one of the driving forces behind the growth of the United States. Finally, the post-Panic of 1819 recovery process highlighted a new understanding of the cyclical nature of the economy. The crisis showed that periods of prosperity could be followed by moments of contraction, and that the real strength of a nation lay in its ability to adapt and learn from these cycles. The extraordinary process of economic reconstruction served as preparation for future crises, shaping a more mature and resilient economy. The lessons learned during this recovery would be essential for developing more balanced economic policies in the years to come. The lasting legacy of the Panic of 1819. The legacy of the Panic of 1819 was deep and lasting, shaping the economy, politics, and even the culture of the United States. This event marked the country's first major economic crisis and left lessons that resonated for generations. One of the main legacies was a realization of the importance of stronger financial regulation. The crisis exposed the failures of an unregulated banking system, where speculation on land and the unchecked issuance of credit led to collapse. After 1819, it became clear that for economic growth to be sustainable, it needed to be supported by a more responsible and regulated financial system. This event also brought a shift in how Americans viewed the government and its role in the economy. The Panic of 1819 sparked intense debate about the extent to which the government should intervene to protect the population from crises. The extraordinary suffering caused by the lack of financial regulation led to a popular demand for stricter supervision of banks and other financial institutions. Although reforms didn't happen immediately, the panic planted the seeds for future discussions that would culminate in the creation of an economic safety net and more interventionist policies in the following decades. Another important aspect of the legacy was the impact on public confidence in the banking system and the financial elites. Many Americans, especially small farmers and merchants, felt betrayed by the banks and the government. This sense of distrust didn't fade over time, but instead fueled populist movements that demanded economic reforms and a more equitable redistribution of wealth. This political phenomenon would be felt again in future crises, such as the one at the end of the 19th century, and even during the Great Depression of 1929. The Panic of 1819 showed that the extraordinary power of credit and capital needed to be balanced with justice and prudence. Additionally, the Panic of 1819 also influenced how Americans approach credit and investments. The lesson that uncontrolled speculation could lead to ruin became a powerful warning for future generations. The crisis taught that, no matter how intelligent and promising an investment may seem, caution and rigorous analysis are always necessary. The financial trauma caused by the crisis made people more cautious when dealing with banks and about relying on credit, changing the mindset of American investors and workers. Culturally, The legacy of the Panic of 1819 can also be observed in narratives about the American dream, the exaggerated optimism that preceded the crisis, with the idea that anyone could get rich by buying land or investing in agricultural enterprises, was seriously shaken. The concept of easy success was replaced by a more realistic view that economic progress required hard work, planning, and, above all, prudence. The extraordinary impact of the crisis shaped a more cautious and resilient mindset that would continue to influence American culture for a long time. Finally, the legacy of the Panic of 1819 helped lay the foundation for the development of a stronger and more structured economic system in the United States. The lessons learned from the crisis paved the way for future reforms in both the banking sector and monetary policy. The need for a more diversified economy, less dependent on speculation, and better supported by efficient regulations was one of the main takeaways from this period. The Panic of 1819 served as a historical milestone, showing that while crises are inevitable, they can also be moments of extraordinary learning and transformation. The story of the Panic of 1819 shows us that great crises can forever transform the course of a nation. But what about you? What are you doing to learn from past mistakes and avoid similar traps today? The key to success is understanding economic cycles, making intelligent decisions, and acting with caution. How can you apply these lessons to your own financial life? Share your thoughts in the comments. And don't forget to subscribe to the channel and activate notifications to keep learning about historical moments that shaped the world. Let's continue this journey of knowledge together.